Hello, everyone. Thank you so much for joining us yet again for our Mortgage Minute with the Mortgage Minds. Why are you listening to me? Well, I'm Alex Ward, broker owner of Maxwell Devonshire Realty, but I'm not the real reason you're here. You're here to listen to Megan Wendell and Diana Lee of the Mortgage Minds, two of the industry's best mortgage professionals. And they're here today to talk to you about self-employment, structure matters, payment matters, all of that matters, but they're going to explain why. So, ladies, the floor is yours.
Thank you. Thank you. Thanks for having us. We're always excited to be back. And this is our fifth session that we've had. So thanks for everyone who's watching and attending. We so appreciate it. I'm Diana. I'm a mortgage broker here in the city. I've been in the industry over 15 years and previous to that, TD for 15 and proud owner of the Mortgage Minds and get the privilege to work with Megan Wendell every day. Megan?
I'm Megan Wendell. Yes, the privilege is all mine, Diana. I am a mortgage broker under the Mortgage Minds. We have a fabulous team of amazing brokers with 130 years combined experience. My experience is about 11 of those years, so we've kind of been through some economic changes and seen a lot of things, and we have a lot of experience to draw from in terms of the mortgage experience. And it's a wonderful place to come from. Here today, we are talking about business for self. So, roughly 350,000 Albertans are self employed. That's just the ones who claim it on paper. So, there's lots more entrepreneurs out there. And qualifying for a mortgage when you're business for self can look very different. Just like no two businesses are the same, no two business for self applications are the same when it comes to mortgages. So today we're going to kind of give a little bit of rundown on the three different structures of business and how those are different in terms of how you would qualify for a mortgage. So here's a quick breakdown of the three different types. We have your sole proprietor. So that is you are your business. Your income and your business income are one and the same. You do have some expenses that you try and write off through your business, and those are typically done through your T1 general and your statement of business activities when it comes to reporting to the CRA. When the second structure would be your incorporation, your corporations, pardon me. If you are incorporated, your business is its own legal entity. You may pay yourself as one of the owners of that business a salary, or you may pay yourself via dividends. And then lastly, we still see on occasion partnerships. So these limited partnerships are ownership with one or more people. They share income in terms of the access to funds, and also the way that we are structuring these mortgage applications is dependent on the percentage of that partnership that you hold. So this is a good place to start, these understandings.
Yeah,
Why does this matter,
absolutely.
Diana?
Well, it matters because obviously, like if you're a sole proprietor, incorporated, or partnership, it depends on how you're stating that income on your personal income tax returns. It really depends. Why it matters is we need to see what the net income is, and it all depends on what category you fall into. So that kind of leads into why we ask for these documents so then we can actually see where and how you qualify based on the structure of your business. So let's just dive into sole proprietor for a quick second here. So, sole proprietor, you are your business. You have your gross income that you claim, and yet if you break down in your T1 generals, you have expenses, and it can show you how much net income you would be claiming with the government. In those cases, so many lenders have different policies. We can look at either grossing up that net income that's claimed on the past personal taxes, excuse me, the tax returns. You can gross it up. We can add back certain expenses depending on what your expenses are. For example, it could be motor vehicle, a lot of write-offs, like certain things like that. And so when we qualify someone who is sole proprietor, we like to see what the net income is over the last 2 years, and then we can determine how we will qualify you. And sometimes it's just simply as, you know what, you claimed enough net income, it's good. We take the average of the 2 years and off we go. And that would fit in so many lenders and their guidelines. But the reality is if we're short a little bit and we've got to make that income fit in a certain number, then of course there's ways we can add back, right? So it's not always the whole picture as to like what is claimed on paper. So we
And
know that.
truthfully, we realize that there is a reason why you are a business for self, whether that be a true passion or in terms of revenue. And in that sole proprietor, excuse me, in that sole proprietor form, you are looking to utilize as many tax advantages as you possibly can in terms of write-offs. So a lender sees this, and there are policies from lender to lender that how make allowances for that to be able to put you back in terms of a more
Favorable application.
exactly, yes, favorable. That's the word I was looking
That's
for.
the
Thanks,
word.
Diana.
So then when you're incorporated, of course, we have a business entity, the business revenue goes into the company. And often as the owner, people are pulling out dividends. Sometimes they're just, set on an annual salary and they T4 themselves. There's so many different ways now that an applicant who owns a business incorporated can pay themselves. So, if you take a T4 income and it shows consistently you've taken a T4 salary type income for the last 2 years, no problem. We can take that. Often we'll see dividends being pulled out of a company and we can look to see, is it consistent? How did you pay yourself? Sometimes structures change also within an incorporation. So that's kind of where we can fall into different lenders with different qualification rules. Sorry, my printer decided to just go right now. And so with that, we can look at the overall picture. And if that income that's claimed is a little bit short or a little bit lower than what we need for you to qualify to do that purchase, we can look at things like adding back net income that shows on financial statements and add that a percentage of that net income to the application and therefore qualify in the perfect little box that we need to make it fit. Or sometimes, again, we can get financials, we can add back capital costs, amortization, motor vehicle. Some lenders have a cash flow like sheet where we can kind of look to say, here's the revenue, here's the expenses, and kind of maneuver and show the lender that this is truly how much a personal income would typically be. There's a lot of options there. And with financial statements, of course, the preference ideally is like an unaudited or audited financial statement from the accountant, but we can take T2s too. There's so many different documents that we can take a look at. We'll touch on documents soon. And we can also gross up as well. So there's certain things and different little pockets where we would be able to determine based on which lender and based on which program and based on which guideline. So it is a little extensive, but that's the beauty of having options.
Yeah, you are going to find that the process will involve your business financials in this structure a little bit more than you would necessarily on a sole proprietor type of structure. It really does help create the full story for a lender. And so, yes, it's a bit more documentation. However, sometimes that can be very advantageous in terms of trying to qualify for a mortgage.
Yeah, and just like last note on that, what if, you
Mhm.
might have great revenue, you choose to keep all your income into the company, you choose to take out like a lower, I guess, bracket of personal income, right, to avoid taxes, but you have a lot of money in retained earnings too. So that is the big picture of your company, and that really does give us a story to tell the lender to position that you have a strong company. It's just that you choose not to take out that much personal income and see where it fits. So that is one of the things that we like to look at. In respects to partnership, similar, right? We definitely still look at, what did you claim personally? What's your income taxes? What's the story? What's the financials? However, it does kind of break down to how much of a percentage that you own in that company. Of course, if it's 50-50, we can pretty much go forward like we normally would. But really, what the partnership does is it really tells us a story as to what percentage could you take out of your business account should you need it for a down payment. And
That's
so
right.
that kind of, yeah.
Yeah, those down payment needs are especially if you have a retained earnings type situation where that business has some strength in that area, we would just look at the partnership agreement to see what percentage of your ownership would be relative to the percentage of that retained earnings that's in there and how you can draw from that. That might look like not just your partnership agreement, but maybe a letter from your accountant as well, stating what you are entitled to in terms of that percentage when it comes to down payment funds.
Right. So overall, part of our discovery calls, it's really important for us to understand, what do you do for work? Do you own a company? And if so, what's that structure? Because that structure, ideally, then we can focus on, okay, which box do you fit under? And in that box, what exceptions do we need? And it does start with collecting documents, because that is the baseline of us for having the ability to know exactly kind of which way we're going to go. And so documents are important. These are a good example of what documents anyone's going to need if you are a business owner, or a partnership, or something to do with some sort of business. So last 2 years of T1 generals. These are the electronic documentation that the accountant fills out and then submits it to the CRA. And then when the CRA receives it and files your taxes, and then you receive something called a notice of assessment, an NOA. So we actually need it all. We need to see that you claimed your taxes and filed it. So T1 generals, 2 year, and the full package. It goes through everything. Your accountant always has this. You can ask for a PDF copy, and it's always good to have those saved in your file regardless, just for your own personal file purposes. Notice of assessments is what we need. And then we also need something called a statement of account. This is showing that should you owe CRA maybe 15,000 in back taxes, or income taxes, I should say, or maybe even 2,000. The statement of account shows that you have paid the CRA, and this is important for us to get, because you know what, when you do go forward with a purchase or a mortgage, the banks do want to make sure that the CRA is all paid up and there's no taxes owed. Now, side note, real quick, if you do owe taxes, there are ways around it, but it's important for us to see. So that's actually a document we do ask for right away. Let's just say you guys owed 5,000 and it shows that you have not paid it yet. We could debt service that and kind of explain to the lender it's a smaller amount, get an exception, and move on. But yeah, if it's something exceeding over 10,000, sometimes we do need a payment made to it to ensure that CRA is paid. So, and then financial statements, we alluded that I would say like 80% of lenders need a financial statement, because it does give the full picture. We do ask for it, because why not be proactive when we are qualifying? But there are lenders that don't need it. It depends on loan to value. It depends on credit. It depends on, do you even need it because you claimed enough income on your taxes? So you can see there's so many moving parts in this category. But we certainly like to be very transparent with everyone and asking for like a lot of docs up front.
Additionally to this kind of portion of our topic here, in terms of the documentation, planning is so important. So having the discussion early with your mortgage professional is key to being able to either structure your accounting practices so that you are in a position to be able to qualify well, or taking a look and making sure that all of your paperwork is in order before you start the purchase process is really, really important in terms of diving into this.
Yeah, absolutely. Absolutely. And, just a quick example of that, we often talk about the calls that are coming in now. Not only are we into spring thinking, right? We're thinking forward already in 2026, but the calls, whether it's now or, any time in the year, it really gives us a great point to say, wait a second, what would it look like if you filed this? What if we're short a little bit? Let's create a plan for the next tax year. Or, you know what, you do OCRA. This is what needs to happen before you buy in spring. There's all these strategies that we need to put in place so that's a win-win for everybody. That's our end goal. That's our result. That's the result we want for everyone, and a happy client experience, right? With honest, transparent, and real advice right up front.
Yeah. And we look at this package, this full picture, and it is our job to be able to select the right lender for these types of circumstances. So we will look at, your A side these are the ABCs we talked about last week, or pardon me, 2 weeks ago. So we will look at your A side with verifiable income. It's kind of a little bit more straightforward. We will look at the B side, or the alternative alternative lenders for slight exceptions that need to be made, or short-term solutions that are there to be able to help you bridge the current structure of your businesses into something further in the future. And then same thing with private, where there might be circumstances where you need those funds in short time frame, and also maybe just need a little bit of help in order to bridge things as you are moving into a different phase of your business as well. So we do take a look at those very, very differently, but all of these documents together help us to create that picture so that we know exactly where to direct you.
Can I just jump into those ABCs just as a quick example? So,
Yeah.
to conclude the meeting, so it just can kind of paint a picture. So on the A side, typically, let's just use like TD Bank or Scotia. We want these rates that make sense for the clients. Everyone is happy. They're purchasing a house. They claimed enough income, then it's no problem. 2-year average, submitted it through, it's a clean deal. Two, they could really want that $600,000 house, but they only qualify based on their income for 550. Well, this is where then we would look at grossing up. We would look at add backs. We also have under the A side with the insurers stated like an alt A stated income program. So in the A side, if that client really wanted to put 10% down or 15 and get an insured mortgage, but again, their income is just a little short, there's actually a program where, it does come with a little bit of an insurer premium, but you still get A lending rates from the monoline lenders or the banks. And we're able to position that this company might have, or this client might have only claimed 50, 60 grand on their taxes, but look at the business, look at the cash component, look at the type of trade he's in. And he recently went incorporated, but he's been in the same industry for the last 5 years. There's so many stories and strength that we can bring up for that client. And then in theory, use perhaps maybe 80,000 on the application, and it comes with an approval through an A lender. So in that A space, we have lots of options.
Yeah, and the product that you're specifically talking about is really ideal for someone who has been business for self for less than 2 years. So this is ideal for someone who has transitioned from the same industry into business for self with less than 2 years, to be able to give a full picture as you typically would with someone who is a little bit more established in their business. So this is really ideal for that type
Yeah,
of
and
person.
that's actually with one of the insurers. If for some reason you're actually business for self for more than 2 years, we would go to another insurer, which allow us to use stated income as well. So again, different insurers, different policies is just it's like it just drives down to like 10 steps as to every file. On the B side, I want to quickly touch on, again, of course, we can do the add backs and the cat like the add back on the amortization and make those numbers work. But on the B side, we actually have alternative lenders that will look at 12 months bank statements. So if again that personal client only claims, let's just use 80,000 on personal income taxes, they want to buy a certain purchase price that's a little bit too high, we can actually go into stated income, ask for 12 months bank statements, look at all of the revenue coming in, all the deposits. We do deduct expenses, certain like a formula as to how much we can actually use from that gross. But there is a percentage where we can actually say, listen, this business clearly makes well over what he claimed on 80. And all we really need to do is actually make this 80 110,000 for application purposes. These B lenders, they're alternative lenders, they might charge, maybe a 0.75% higher than an A. It's not anything crazy. They're
Yeah.
actually under 5% still, but it gets them into the house. So it gets that client into the house. You do need 20% minimum. That is one of the key things, but gets you into the house. And Megan alluded to this earlier. You can either stay there, sure, and just take that B lender and continue on. But the reality why we would use that is get you in the house, start building your equity, get that roof over your head. But in 2 years, we strategize with them, and then we will show them, hey, we need your income to be here in a couple of years, because again, now he's going to have 2 years consistent, and we can then refinance them and move them back to an A lender, and then continue on with like lower rates and all those type of things. So there's various reasons why we would go to a B lender, but that is part of a strategy on a B lender as well. And we do this program all the time. This is where a lot of business for self clients do fit because at the end of the day, they don't want to claim 150 on their personal taxes because the amount that you would pay to the CRA could outweigh the benefit of just paying a quarter, maybe even a 0.5% higher, right? So there's lots of reasons why we would have these conversations.
So now you see that being business for self is a bit like a choose your own adventure book. There's so many pieces and details that go into it. Relying on someone who can help you navigate that process is really, really important. And we are happy to be able to answer any questions that you have to be help you be informed on the process and make the right educated decision on your end.
Yeah, absolutely. Yeah. So there's so many things. Please let us know, of course, with you, Alex, too. Like, did you have any questions or anything that comes up?
No, the
That
biggest theme that I'm getting in all of our wonderful seminars that we're doing is it is important to communicate with your mortgage professional early in the process, right? Because especially if you're business for self, you want to have, bring your accountant into it, your bookkeeper, your mortgage professional, your real estate associate. You want your entire team that's going to be working with you to ensure they're all on the same page and they all have your best interest in mind.
Mm,
Because, like they're saying, paying more income tax might not be the best thing for you, or a higher rate might be the best thing for you, right? Each situation is going to be independent upon itself. So you really need that team around you working for you.
yeah, absolutely. The beauty is options at the end of the day.
Yeah.
But that is our fifth series. Our next one's going to be in person, so you have to attend live for the Lunch and Learn on December 18th. If you're watching this on YouTube, make sure you hit that like and subscribe button so you don't miss our next one when we're going into the new year. But as always, thank you much to the Mortgage Minds for your Mortgage Minute. See you,
Thank
everyone.
you.